All right, so this is the presentation on Kiddie tax. So this is for the federal taxation accounting class, and this presentation will be by Shannon Bilowski, Justin Hislop, and David Petrevsky. I have the first portion, and my name is David Petrevsky, and we're going to move on with Kiddie tax. So first off, what is the code section for this? So this actually falls under the 26 U.S. Code 1, Tax Imposed Section G. So kiddie tax is almost like the slang term, and what this is Code 26 is all federal tax law. So there is a bunch of different sections that's in this, and we're going to focus on G, which is where kiddie tax falls under. So what is kiddie tax? So kiddie tax is the tax on child's unearned income based on the tax rate applicable to estates and trusts. Got this information from the book, and what is classified as a child, and that is any one individual that's under the age of 19. So what are the limitations of section G, kiddie tax? So kiddie tax, like we talked about in the previous slide, is there's a certain amount that you're excluded from, and you can take advantage of, if you have enough money, you can take advantage of this tax law and this deduction. And what the limitation of this law is that if a child has income that is not earned, such as investment income, aka like a gift, then it is taxed at the parent's marginal tax rate. This pertains to income above $2,300 in 2022. So that means anything above that is going to be taxed at the parent's income, which means that is the limitation. So it's limited by the parent's income. But on top of that, there are two other limitations beyond the $2,300. So the first $1,150 is of unearned income, which is included in the standard deduction. So that part of it is not taxed. So if you were to give the $1,150 to a child, that would be non-taxable, which is awesome. That's what everyone's pretty much striving for, which is why you usually take advantage of this type of deduction. The next $1,150 is taxed at the child's marginal tax rate. So if you only have the $1,150 in there, that's all you're going to be taxed on, which the first $1,550 is excluded. So it would be very low compared to what your parents would be at if they're at $50,000, $60,000, $200,000. And who does this affect? So the Kiddie Law Section G of 26, this was implemented in the 1980s to discourage wealthy parents from shifting their investment income to their children in order to take advantage of their lower tax rate. Because who doesn't want to not pay taxes? Everyone. So what this is going to do is this will limit how much parents can contribute to this. So yeah, it's an extra deduction of $2,300. First $1,150 is tax-free, it's not taxed. So it's a nice deduction to have, but that is the limit to it, because other than that, no one's going to give more than that $2,300, because then it's at the parent's tax bracket range, and at that point there's other things you can investment that would give you a better return on investment. So this is my section. I'm going to pass it off now to Justin, which will take care of the next half. Thanks.